A lot of you have been asking what my investing strategy for the rest of this year will be, as well as what kind of changes I'm going to make to my portfolio. Well, actually, nobody's asked me that yet, but somebody out there might be thinking it, so don't worry, I saved you from having asked that question. Today, we're going to be taking a look at my Watch This Wednesday portfolio, and I'll give you some objectives for what I'm going to do with this portfolio, looking at it for the rest of the year. Hey everyone, and thanks for joining me today. My name is Matt, and if you're new to this channel, thank you for watching this. The reason why I'm putting that out is because last week my video about rocket companies, again, which was a suggestion from Timmy Pom Pom, is actually my best performing video I've ever had. We had a bunch of new people join the channel, we had a lot of people watch that video, and I'm just beyond appreciative of the feedback I've been receiving, the discussions that all of you have been having in the comments section for that video. So thank you so much to everyone who watched that video, who liked it, left a comment, and even subscribed to my channel after watching that. Really means a lot to me, and I'll be honest, I didn't know how I was going to follow that video up because it just did so well, and I wanted to make sure I wasn't disappointing anyone. So since we have some new people here, I want to talk about the portfolio that I've been building every Wednesday on Watchlist Wednesday by evaluating companies and making small investments into them and just reviewing the performance, what we have, all that good stuff. Now, when we take a look at this portfolio, the one thing I want to address right off the bat is the portfolio I'm using is E-Trade's paper trading, so it's not my actual money. Now that said, I have very much treated this like it's my own money. I've invested in ways that I would feel comfortable, really in ways that I would feel comfortable sharing with all of you, which is why it's a pretty defensive portfolio, but stocks that I felt comfortable with, and the results are really speaking for themselves. Reason why it's paper trading and not my actual money is simply because I just don't have that much money. I started a real estate career, it's been pretty expensive, and it's not the easiest to start a career during a pandemic, but I didn't want that to hold me back from showing all of you my investing strategy, thought process, how I make these decisions. So I decided to use paper trading, and maybe either once real estate starts booming again for me, or maybe once this channel takes off, then I'll be putting real money into these investments and having all of you follow me along that journey as well. Now, before we get started, I just want to give a quick timeline for this video so you know what to expect. So first, we're going to start off by defining the objectives that I have for this portfolio, or how I'm going to treat this looking forward. And then we're going to review the positions that I've already put into this account. And then lastly, I just have about 2 or 3 stocks that I'm going to give to you. And they are going to be the ones that I do for this week's Watchlist Wednesday. So I'd love to know which one you guys would rather hear, or if there's a different one that you'd rather me take a look at or think might be a better better fit inside this portfolio. You can leave that in the comments down below, and I'll gladly take that into consideration. So let's kick this off by starting about the goal. And what's really prompting me focusing on this goal is when I was doing my videos of reviewing ETFs, or just talking about income producing ETFs and growth ETFs, I noticed all ETFs, it kind of occurred to me, all these ETFs have an objective. And when I thought about my Watch This Wednesday portfolio, I realized I don't really have a set objective for that portfolio. And I've just been kind of picking stocks. Again, stocks I think are good investments, but I've just been kind of picking them out of the blue and putting them into a portfolio. So I figured maybe a smarter, more strategic approach would be to actually sit down and say, what do we want to happen with this portfolio? So kind of came up with my version of an ETF description, and this is what I have so far. Additional positions in this portfolio will be purchased through the dividends that are paid out from the stocks that we own, as well as selling off any underperformers. So basically, once I run out of the $100,000 from the paper trading, then I can't add any fake money to it. So we'll only add additional positions through dividends and selling off the underperformers, which I'll kind of define later. And I want this fund to have a tax efficient objective, meaning that we want to have minimal turnover in this actively managed portfolio. Now, when I say moderately aggressive, moderately defensive, reason why that comes about is because I was listening to an interview one time with Howard Marks, and I've said this before, but Howard Marks says when you start building a portfolio, the first question you need to be asking yourself before anything else is, do we need to be aggressive or defensive? I feel in times right now with the market being at all-time highs, record highs, seems like every day, and with this being an election year, I personally believe it's a good time to be defensive. I certainly don't think it's a time to be out of the market, but I think taking on substantial risk right now could be detrimental towards the portfolio's performance. So I've been taking a little bit of a step back myself. Yeah, I'm 26, so I can afford to be aggressive with this. But at the same time, I don't want to necessarily lose it all or buy something that might present a better buying opportunity within the next 6 months to a year. Also, there is one more thing I want to address about this portfolio, or kind of my stance on it, before we move on to the positions I put inside there. And if you followed me for a while, or even if you're new, I'm a long-term investor, so I don't buy positions based on how it's going to perform over the next 6 months, 3 months, 2 months, day. I like to buy with a long-term approach. Now, yes, I did just mention that I'm purchasing stocks that, within the next 6 months could be cheaper, but that is because it's an election year. So when it comes to how these positions fit in the portfolio, that is because, we're looking at this with like a 5 to 10 year time horizon. Now, that being said, when you have 5 to 10 years of investing in something, waiting 6 months because there could be a chance of a better buying opportunity to get better value for yourself, I still think fits in that long-term mindset. Some people won't even hold on to a position for 6 months, which gives them the short-term mindset. But since I'm looking at this for such a longer time than that, I think it's appropriate and better to either wait until there's a better buying opportunity than what you think currently is available, or doing what I typically do on the channel and buying things in thirds. So putting in a position once we do the analysis, if it has strong upwards momentum, maybe buying another third then, or if we see a better opportunity, putting 2/3 into it. I hope that makes sense. And also I want to say that election years generally don't have a long-term effect on the stock market. So I'm not saying that the election, this isn't a political stance, or it's not going to be anything along those lines, but generally we do experience higher levels of market volatility when there's an election. So I think that could create a better buying opportunity. And right now what I'm doing is purchasing companies that I don't think will be affected regardless what happens and might not experience that same volatility, and then holding off on what I'm going to call the more aggressive investments for those times when we're experiencing volatility, since they might present that better time to buy. So just a quick summary here of what I mean by having the moderately defensive portfolio is, again, we're having a 5-year time horizon. We're looking at stocks that will produce income as well as some that produce growth, but we don't want to be too aggressive. And I think maybe the best way for me to do that would be to do a little Casey Neistat style and draw it out for you. So give me 1 second. Let me see if I can draw this out. So I'm not sure if you'll be able to actually see this at all. And if not, I'll just take like a scan of it and upload it. I'll figure that out later. But so as you can see, so what I did is just draw a line, and we have defensive and aggressive. Yeah, I'm looking at that right. And if they're both a 10, in the middle would be a 0, meaning it's a balance between aggressive and defensive. I'm okay with what I'm going to call a standard deviation of 2. So if we hit like a 2 on the aggressive scale, I'm okay with that. And if we hit a 2 on the defensive scale, I'm also okay with that. But I really want to stay within those guidelines. Right now, I feel like we're at a 4 on the defensive. So I think we're definitely more heavily defensive than we are aggressive. So I'll be okay with taking on a little bit more risk to maybe add a little bit more growth into this portfolio, since a lot of the investments we have currently are on the safer side and generally considered a defensive investment. So hope this gives a better visual representation. But now we can move on to the stocks in this portfolio, and you could see how well we've been doing. All right, so let me go ahead and pop up a screenshot on my screen so you can see the portfolio through the E-Trades paper trading. Eventually, I'm going to switch over to the tracking I have in a spreadsheet on numbers on my computer. But for now, just so you can see the actual portfolio itself, there's a few things I wanted to point out here. And so we've been doing this now for 17 weeks. The first company I did was Peloton, and funny enough, Peloton's actually our best performer by a lot. So worked out well, and I'll be honest, I thought I bought that one at a little bit of a high price. So when we take a look here, again, with this paper trading, I started off with $100,000 fake money, but everything here actually mirrors the market. And earlier I said I would talk about the underperformers. I think this is a really good opportunity to discuss that. So looking at something like Peloton, it's up $1,700.31 and $1,731.73 since we purchased that position. A lot of times people think that's the one that you would want to sell out of because you have such high gains. Now, if this was a real account, a non-retirement account, that might not be something that would be wise to do because that could incur a pretty large tax liability. So what I like to do, and again, do whatever works best for you, this isn't advice, but I would rather sell out of something that just it's been a dud. It hasn't really performed the way that we ever expected it to, or just hasn't been as promising as some of the other investments we have. And weirdly, the best one I can compare that to here is Spotify. Now, Spotify also, weirdly enough, is our largest position by dollar value. We have $6,000 invested in that one, and it's only returned us $68, and 16 of those dollars are from today, within the past hour and a half that the market's been open. So that's a little concerning to me. Now, I know that Spotify just had a pretty big deal go on. I think it was with Warner Music Group. They have all their podcast stuff that they're working on. So it's not necessarily going to be, I'm ready to sell it today, because I think that it could be one of those that right now is just holding steady and then eventually will pop. But in the event that it just stays where it is, this is going to be the first one that I sell out of because it's an underperformer. Now, you might be looking at this and saying, well, Matt, what about a company like Activision? That one only has $19 in gains. Thing there is I bought that one last week. So I also take into consideration how long I've owned these positions before selling out of them. If it's been a position that I've owned for 3 months, then it is going to be one that I consider selling out of. But if it's a position that I've owned for just maybe a month, then no, we're going to hold on to it and just make sure, again, that it has the opportunity to grow the way that we hope it would. Also, I think just trying to sell out of something like Spotify right now isn't the long-term mindset that we're after. And so again, unless that one just takes a plummet and we think that it's never going to recover again, I'm going to hold on to it until we run out of money in here and I need more money to make additional purchases of other investments for this portfolio. Right now, we do only have $33,000 left in cash compared to the original $100,000 starting. But with dividends being paid out, again, if we keep getting these $1,000 in dividends every quarter, then that will also help with the additional purchases in this portfolio. I did take a look at this earlier, and I took a look at all of their betas, and I think the average portfolio beta here, this is taking out of consideration Peloton and Chewy since they just haven't been along around enough to really have a good beta. I think the average beta is 0.92. So we're a little less volatile than the market if you just look at it from a beta perspective. And I guess that's maybe how I should have drawn out that line there. But if we can get that beta to maybe around 0.98 for the average portfolio, maybe 0.96, then I think we'll be in perfect shape looking at this for the rest of the year. And again, as we get closer to the election, I'll probably start adding more aggressive stocks. I'm enjoying owning companies like your Ecolabs, McCormick's, 3M's, Walmart's, just pretty straight shooters. Something that you don't really have to worry about too much. Peloton is something you have to keep an eye on. I'd even say you'd have to keep an eye on Shopify, but ultimately, I'm enjoying having positions that I can sleep well at night, not having to worry about, what happens this day at all times. Because managing 17 stocks is not easy to do, and it makes my life a little bit easier if I'm able to just say, hey, it's not a company I have to worry about, so I don't need to constantly be reading about their earnings or their news reports, making sure that there's no scandals going on. So I'm happy with this portfolio. Again, given that we started this right at the peak of the pandemic with lockdown and everything, and have still been able to have a total year-to-date gain here of $10,223, I would be super happy with that. And admittedly, I'm kind of jealous this is not my real money, because who doesn't need $10,000 right now? Now, I did also say at the beginning of this that there was going to be 2 stocks that I'm considering doing for this week's Watch List Wednesday. I said 2 or 3, and I'm just going to focus on 2 for this week because I think both of these are a good opportunity, but one obviously I'm going to have to do my full research on before this week, so I'd love to hear your feedback for which one you'd rather see me add to the portfolio. And the 2 companies I'm considering for this week are Dollar General and Monster Energy Drink. Kind of weird companies, I know, but I have my reasons, and whichever one we decide doing, you'll hear my reasons why I'm picking that one for this upcoming Watch This Wednesday. So maybe not my most informative video. I have a few others that are more educational coming down the pipeline, but for those I really like to take my time and do research, create slideshows, all of that, so it's easy to follow along with. So stay tuned for that. We're going to be taking a look at ARK funds as well soon. So I have a lot of good content coming down the pipeline, and I'm super excited to share all of that with you. I also want to get back to talking a little bit more about real estate, so stay tuned for some real estate info as well. Well, if you know me, you know I'm super awkward with intros. If you're new here, I'll just apologize in advance. I'm really bad with outros, not intros. I don't even know what I'm saying anymore, so let's just wrap up here. Thank you so much for taking the time out of your day to watch this video. If you liked it, I hope that you very gently hit the thumbs up button. Again, I want you to have a computer so you can watch my next video. Don't smash it or anything. If you like this and you are excited for maybe some more content, I would be super appreciative if you subscribe to my channel, and definitely let me know in the comment section down below what questions you have. Keep the discussions going. I've been really enjoying reading all of your stock picks and your thoughts towards these, because at the end of the day, I'm one person. This is all my mindset and my approach towards investing, and there's so many different ways to go about it. So I enjoy learning from you as well when you give me your feedback for maybe something I missed, or if you view something in a different light. So leave that in the comment section down below. And with all of that said, you could be anywhere in the world and you're right here with me. So I really appreciate that. Thank you again for watching this video, but I will let you go ahead and enjoy the rest of your day, and I'll see you next time.